Hello, ladies and gentlemen, and welcome back to a very special edition of the Markets Around the World. We'll be talking about the key levels to watch this week for stocks, commodities, and cryptos in today's discussion. But more importantly, we'll be looking at money flow. Where are the biggest players moving? And more importantly, where are they putting their money? We'll be discussing some sectors that have improved recently, that have been some of the worst of 2022. And we'll also be talking about realistically whether the dollar index can start to recover. We saw a little bit of signs of potential recovery on the Friday session. Stay tuned. This will be a good one. Well, welcome back everyone to the Daily Show. We've got the news, the macro, the lead indicators, and the key levels that we should be watching this week. But we'll begin here with Black Friday sales because crowds were thin despite the deals. Consumer discretionary stocks have been getting pretty much hit for weeks and months now throughout 2022, and it makes sense. Usually when we're going into demand destruction or an interest rate hiking period, it puts a lot of pressure on the average consumer. They buy less and they focus on what's most important to them. And hopefully this Thanksgiving, for all of our American audience out there, it was spending time with your family and, of course, hopefully having a great feast. Let's talk about the worst starts to the year since 2000, and this is on Thanksgiving date. Now, it's interesting here, and the reason we're talking about these stats is notice the negative ones. The rest of the year tends to be negative, average at best, or even seriously negative. So these are some of the worst periods of the years. Of course, the notable one being 2008 and a pretty lackluster return into the end of the year. I mean, 1.8% is nothing to sneeze at, but in the state of 2022 markets, that's not a very big move. Now we're coming in with negative 15.5% in 2022. What are the stats? Well, they don't really bode that well for incredible rallies. They bode more for flat to down risk. And I think that's in line with where we're at with the markets right now. Let's talk about money flow though. Let's talk about where the asset managers are going and also more importantly, the big leverage players. So big leverage players in recent weeks have continued to short this rally. And they're not shorting it incredibly, but they certainly are ramping their short each time the market goes up. They're adding to their short positions. Asset managers, on the other hand, have been reducing their short positions and going a little bit more net long. So they're starting to actually buy up the markets. Now, it's a crisis between both of these. Who's right? Is it the asset managers or is it the leveraged money? Well, leveraged money tends to be a little bit more correct a lot of the time, and then asset managers eventually take over the flow, and we see that in price, breadth, all of these other things. So one will be watching. Now, conversely, if we have a look at another market that we're very interested in at the moment, and we have been for quite a few weeks now, about 2 to 3 weeks, is gold. And we've seen another incredibly strong week of gold purchasing. Now, this is important because when we discuss the ideas of stagflation, which is where we have interest rates at a higher point for longer, and of course, we can't kill or can't stop this inflation and it starts to become sticky, then we go into stagflation. Also, if we believe that we're getting close to the terminal rate, a lot of people misinterpret that gold is some kind of hedge against uncertainty. What instead it does very well at is when rates go down, gold does tend to go up. And that's something that could be happening as soon as 2023. So the markets are starting to buy into these concepts. I just wanted to put a quick reminder out there to a lot of investors and to swing traders that actually it really is technically better over long term to hold your positions overnight. Now, of course, there's risks in that, but it's just interesting here to see stocks working best overnight. The overnight session tends to do something. The intraday session tends to take a lot of that back and then go back. So let's say we opened up gap up, then the market opens the next day and we're over here. What will often happen is it will come back, return, grab the liquidity and push through. Just an interesting concept. And I think it's something that a lot of people still don't realize about markets, that actually some of the best work done for markets over the last decades has been overnight sessions, something to keep in mind. Now, we have some big rotations going on here from Wall Street. In fact, XLU, one of the most defensive sectors of the market, is now the best returner over the last 5 days. I think maybe the algorithms had a little bit of Thanksgiving blowout after eating all those turkeys because they weren't able to get us some good data here on the Friday session. But what you can see here is a clear rally into metals, mining, defensives such as staples and healthcare, and it really wasn't the normal crowd pushing up these markets in recent days. So we saw one day of sell-off, which was, of course, the Friday, thin trading day, hard to gauge too much from that, but still a very important one. Just before we get into the charts and we keep going a little bit further, I did want to remind everybody, come and follow us over at FX Evolution. That's FX Evolution spelled correctly, just like this. There are a few imposters out there, unfortunately. We will be sharing one of our private reports on Twitter. We're going to be doing that moving forward each week. So if you follow us over there, definitely could be worth your while. So 2022 has all been about interest rates, but 2023 could be about valuations. Yes, you're going to need a broker that can give you the information at hand about stocks, whether it's summaries, filings, shareholder information, dividends, short interests, or even financial statements, incomes, cash flows, and all of those things. You may need those for 2023. And today's sponsor of the video, Tiger Brokers, has them all in spades. Now, who doesn't love a Black Friday deal? Well, I like Black Friday deals, and I'm sure you do too. Now, the good thing is we've partnered up with, of course, Tiger Brokers, and they're offering an additional 40 zip stocks, up from 40 for the Australian and New Zealand audience. And more importantly for now, other countries are also eligible. So if you're from the US, Singapore, or any of the other eligible countries down below in the description, you'll be able to get an additional 80 free zip stocks when you sign up and meet their minimum funding balances. And of course, we also offered our own little thing here. So if you're interested in our Ultimate Masterclass, there's a 50% subsidy value there. And this is eligible till the 30th of November, which just so happens to be my birthday. So what a great time. Thanks very much for the sponsor of Tiger Brokers. If you're interested, check them out, and we'll get back into the charts right now. Let's now get into the charts, though, and talk about what's going on in markets. We'll discuss here the VIX first. Now, I've talked about the VIX being a great correlation technique. Most people, and I mean a lot of people now, are discussing the idea that last time we saw very similar periods of down markets, so you can see here over in 2008 and 9, we had a lot of VIX 35s, we went down to 20, and then suddenly a horror show appeared. And this was, of course, the beginning of the really, really big sell-offs during the GFC. Now, where do we find ourselves recently? We're back to 20. This has been historically the turning point for bulls and bears, the inflection point. You can see here, 20 rallied up, 20 rallied up. It's been very easy for us to talk about this. Will it happen again? Well, we're looking for the signs, and hopefully we're going to start seeing those if you are a bear over the next couple of days. I mean, it's really an inflection point is coming very, very, very fast. What about 2-year yields? Are they showing us anything that could help the bears or the bulls? Well, I've talked about this. I think that if we get underneath something like a 4.2%, there's a good chance, I mean, this is a head and shoulders, isn't it, on the chart, that maybe we've seen the peaking of the rates, and this can tell us that, yes, the recession is only a few days away in terms of being called, maybe a few months. Most people think March, April in 2023, but it could be very interesting. US 10-year also continues to basically decline compared to the 2-year, and what this is starting to tell us is that the economy is really sick. And the economy is getting sicker by the day. The longer these rates have to be held to kill inflation, the worse pressure is going to be put on my keyword for 2023, which is valuations. I still think that a lot of stocks in the markets are pricing in, a miraculous recovery. If that doesn't happen, and there's always a chance, but if that doesn't happen, we could be in serious problems, especially with some of the tech side stuff. Let's talk about what's going on with the terminal rate. We're still looking at April into September sitting around 5%, so no changes there. It's not like after CPI, the market has gone down considerably. In fact, it's just crept right back up to where it was. So the terminal rate is pretty much the same as where it was before that massive CPI number, which pushed the markets up to where we are now. All eyes, though, need to be on Dr. Copper. We'll talk about this one more in the coming week, but Dr. Copper is showing us that potentially this previous rally here of everything looking so great about the economy may not be that well thought out. If copper falls, and a lot of you will say, Tom, that looks like a flag, I think it's going down. It could, and if it does, then of course we need to be paying attention. If copper falls, we need to be a little bit scared. A lot of you may not have followed copper for a long time, but if you go back to the charts and look in 2014, 15, Other than the US, which had a lot of tech, a lot of economies were struggling over that period. We had a slowdown within it. And this is something we will need to watch. So copper is on the charts. Let's talk about dollar index. As you can see here, it closed with a daily kind of hammer rejection and a long leg doji, which shows us indecision or equilibrium at the bottom. But underneath the hood, some things did occur. We saw a rally of the markets, and the rally was hit, came to the first kind of point of control and previous area of support and resistance, also supply in here, and it rejected it. But this is the first hint of some recovery going on from, of course, the dollar index. Now, admittedly, we thought that the recovery may happen in this area here, so we have to be full disclosure there. I thought it might kind of turn in this zone. We didn't see the signs of it, but we're starting now to see those signs. We'll continue to watch this. We did think that once it recovered here, it would drop back into this area and then potentially find some recovery. The reasons are fairly clear. The market was kind of signposting it was stronger, but then, of course, the Fed FOMC statement put a bit of a spanner in the works. It's time for the dollar index to do it. If it's going to do it, it needs to do it now. Let's look over to Euro US dollar. This is kind of the proxy for that. Remember, the DXY, the biggest component is the euro, so we can make that up. Now, let's go over here to the Euro USD. So you can see that we have a lot of wicks coming through this zone. Now, this closes, again, long leg doji. Let's look underneath the hood. Let's understand what's going on in these currency worlds, because this is important for stocks as well. And we have a clear selling area for the market. So for the alerts for the week ahead, I think a lot of people will be super interested. Should we get a break above 104.30 plus? You can see all the wicks. You can see the supply that's come through here. It's dumped down. It's moved into this area, found buyers. And then now, if the sellers are going to come in, they should commit through the rest of next week and push it through. Now, where are some key levels for buyers to come back in? Somewhere around this 103 was previously a really key zone a few times. I think that's a good, target zone for quite a few people out there. And I think it'll be the big one that we discussed this week. Hopefully it does get down there just to make things a little bit spicy and interesting. Let's move over to gold. Well, gold looks really good on the charts. We talked about the money flow. Yeah, gold's been being purchased now for a while. It all was hinted to us with these triple wicks down the bottom here. It's since rallied hugely. We then expected for it to drop off. I was hoping on one of these red boxes being achieved, but gold's really strong. I mean, it's definitely one on our watch list here for the multi-months running into something like a January even of 2023. If you're a longer term investor, gold does have a seasonality that tends to do quite well over that period of time. Will it be again here? Well, it's starting to find those signs. So we've got a lower low here. We obviously have the low, the high, and we've kind of seen a nice breakout there. Even with DXY strength temporarily maybe, then gold, you would think, still finding bidders. More importantly, GDX, which is, of course, the stock side ETF, look at it go. An absolute beast at this mode. And it's actually almost hit our first take profit target for these stocks. So this has been one of the most hated sectors of this year. Suddenly, it's got a beautiful accumulation base on it. And I still expect this to be bought in terms of dips moving forward. Let's talk about oil, because we did think that oil may find some buyers here. It did initially. It's been a little bit lackluster. Now we're getting a huge change in oil from the price per barrel to some of the stocks. And I wanted to mention this because I think it's really important we understand it. So first up, I've talked this through a lot of times. I still think oil gets down to this 64 a barrel. I've been saying that since up here, 120 a barrel. And the main reason is because it was a pretty extended and you could see demand destruction coming through. The Fed was trying to do that. But at the same time, you could argue, well, wait a second. Yeah, that's fine. Oil's going down, but my oil stocks have been rallying. And a lot of it is because even at $70 a barrel, oil stocks are still incredibly profitable. But notice the pattern that's starting to appear here. I think you wouldn't want to discount oil's current patterns. There could be a distribution going on. I'm going to be watching it. I'll alert you guys to how it's looking. But at this stage, obviously looking quite nice, sitting at these previous highs, distributing along. Look at this though. This has been the biggest discrepancy we've seen in quite some time. Oil stocks up 84%. Oil, since the start of pretty much the year or the back end kind of a year ago, US oil only up 9%. And to think where it was at one point. Look how it usually tracks it though. If we scroll out through history, you'll see there's generally a form of tracking with it. But at this stage, there's a huge discrepancy. And that happens, but it's something that we need to be watching. And I love to do these types of studies, then bring in some thought process. This is one of the thought processes that I have right now. Well, okay, that's great. Oil and energy stocks clearly a bit, all over the place. But is that historically weird? Well, here we have the PE ratios of oil stocks. Now, traditionally, throughout the last decade, there's been a lot of times where oil stocks have been trading at around 6 to 8 times PE. Now, we are seeing a current price of Chevron and Exxon at about 8 times PE. So it makes perfect sense that they should be sitting around this level, and it's probably not a terrible price for them. They're not expensive, nor are they cheap. They're kind of like neutral. And what that is telling us is that right now, Exxon and Chevron need to continue to make the same amount of money, if not more, of course, in terms of growth, to justify what is probably a neutral to maybe even slightly above the average over the last decade. You can really see here for many, many years it was struggling and down. But of course, there's been also some 14s and some 11s and some 12s. So if this starts to creep up in comparison throughout 2023 or even the back end of 2022, it's something to consider. And I think that this is a neutralized market right now, even with this huge discrepancy on the charts. Let's move over to Tesla. So I said I had to revisit this if we got a bullish wick. And a lot of you guys, I'm sure out there are like, that's right. Never doubt the Tesla, Tom. Never doubt the Tesla. I'll still doubt it. But what I will say is that was a pretty nice week that you guys put in. So basically the markets found buyers. I think a lot of it's just because everyone started seeing the short side and they, obviously it was a bit of manipulation with options probably coming through. So nice wick, decent strength. What does this tell us about the week ahead? Well, nothing much other than if we do get a drop, which I probably still expect, there may be some buyers around that 173 zone for Tesla. So we saw a rally. It's kind of like almost like an island reversal, although I'd rather it makes a better island than this. So this is quite strong. So if the market comes down, potentially some buyers come through. I still got problems at 200 for this stock, and I still think that that's going to be a big day trade, swing trade area, and it could still fall off from there. But yes, the market was plagued with a huge amount of shorts coming through. And while I've been very correct, I still kind of expect this to potentially be the way that Tesla plays out. We'll find out. At this stage, though, drop should be rallied based on the current charts. Semiconductors still looking quite weak. We talked about the island reversal. Friday had some sell-off on this one. Again, needs to kind of continue to sell off right here, right now for that to be the truth. And there's some big gaps that were left after CPI. So this is the CPI, pre-CPI close, and you can see what's happened since then. So there's some big gaps on semis, and semis are starting to weaken. Speaking of semis, we've also got Apple. Apple is very weak in comparison to where it's been. Now, a lot of you will say this is coiling for a huge rally in the future, but we noticed two things about this. It's making a series of lower highs. So that's lower highs or lower peaks that are coming through. Not necessarily what you want to see from the best and biggest stock in the world. What I've always said is, and I've got an alert down here for it, is around this 146. If that gets broken and not instantly rallied, then we've made a new lower low. We've got a series of lower highs coming in, and this could be a bad break for Apple. So again, that pushes us down to this idea of maybe we go back to the pre-CPI number, 138, everything else in the market. For the bulls, what you're looking for is a break of these highs. You want to see push out and effectively what is now the beginnings of potentially a symmetrical triangle or pennant trade starting to play. So yes, Apple definitely one to watch moving forward. XLY versus XLP, one of our favorite consumer discretionary versus staples. 1/3 of the US economy is, of course, consumerism. So we want to see whether that's strong or not. It's lackluster at best. I mean, this is the lowest point it's been on for 2022. I usually like to see this sector recovering if I'm going to believe in the rally. Could be wrong, but historically it's been a very good sector. to pull us through proper bottoming rallies. And that's not something we're seeing with this current rally, which is strange in itself when we look at the bonds soon. Old economy, US 30 versus new economy. It was an old economy day, more defensive for the markets. That's been, in general, most of this rally so far. Ever since we started really finding strength in October, it's been all about the Dow and certainly not so much about the US 500 stocks. The DAX still hitting critical supply. We've seen this level for quite some time. The DAX is sitting there. It's grinding higher. Everyone's trying to short this one. I can see it in the numbers. A lot of retail traders having a go at it. There's no signs of weakness yet. So it's what they call a dull market with a series of higher highs dulling off. You don't short dull markets, but if you see the signs of the dull market actually starting to short, that's when you'll get in. US 100. Now, NASDAQ was uncharacteristically weak, or this was the weakest kind of area of the markets through the Friday trade. NASDAQ has been probably the better technical recently. 12,000 was hit, great supply, sold off, rallied up, hit kind of these daily levels again, and then we've seen weakness coming through. So if we have a look at the weekly NASDAQ, you'll see the long leg doji followed by a long leg doji. What is that? It's full on equilibrium. So effectively, the market's kind of happy with where it's at. It's waiting for the next piece of news. What could that news be? Could it be Papa Jerome Powell coming out and saying something this week? Well, unfortunately, yes, he is. And certainly the markets are prepping for the next bit of news or the next bit of information. I mean, it wouldn't sit like this otherwise. It's clearly happy and it's at equilibrium. HYG, this is high yield corporation bonds. We're still seeing bonds being bought up in a market that's been historically pretty bad. Bonds have been the best place to be recently. Have a look at LQD, which is corp investment grade bonds, one of my favorite little bond indexes when things go well. It's just rallying and rallying and rallying. This is actually a positive sign. Along with breadth, these are the two main reasons that you could say, hey, I'm pretty happy about this rally. There's just so many other strange things about the rally, though. I really wanted to see consumer discretionary and tech being the forefront of the US rally. Maybe because of inflation, that's not the way it is. But yeah, we've got to be careful here. Put your, let's say, non-biased hats on as much as possible. When we're looking at the weight of evidence each way, there's something fishy about this rally. What do you think in the comments down below, though? Are we getting onto something here, or is it just completely not what you're seeing? Why am I saying there's something fishy about this rally? Well, a lot of it has to do with also we haven't really broken the key point. The 200-day moving average sits just above price. That's been a big blocker this year in 2022. We've also got the downward trend line for the S&P 500, the best market in the world to be looking for this. We've got the gap fill that sits above, and we also have the 61.8 fib, which I've already put on the chart for many, many days. And as you would know, we're sitting right on the golden pocket. We sat there here. We sat there before. It's been a big sell point. So a lot of people are starting to go bullish. This is a point where I would be cautious at best. And I think that's the biggest takeaway at the moment. So where is the market? Well, it found itself at the previous highs and it found a little sell through Friday. It does still look pretty good on the charts. I mean, I don't think you could be bearish here unless you want like high risk, high reward style trades with, very tight stop losses. But we saw that rallying build position. It's clear where the bears really will take over, and that's going to be a low takeout of 3,900. We've seen options sitting between 3,900 and 4,010, so 410 and 390, and 400 being the big one for a few weeks now, and they are making so much money. I mean, literally Wall Street is doing incredibly well out of options buyers and sellers at the moment, or mostly buyers, because they're just crushing them by holding the market, waiting for the next big driver. Where are the key levels? Well, for defended zones, you would think something like 4,000 is where buyers could be recommitted if the market does drop, and also 39.40. So the buy positions, that's where you're looking. For sell positions, it's where it is right now, or of course, that 41.20, 4100, 4140 zone, which will be the trend line and everything else. So you've got to be very careful. There's two different sides here. I would call this neutralized at this stage. We're waiting for the next really big signal to give us strong direction. What are we going with, though, in terms of options? Well, here was the Friday. Max Payne 398, stock price 402. They did very well. Look at this. Absolutely horrific what they do to some of us sometimes. 1.35 million units, and they expired it incredibly well. If we scroll through to the second, which is the next big options expiration, you'll see there's equal amount of calls and puts sitting on the 400, and still a decent amount of puts sitting at 390, 380, all of these ones down below. So Max Payne again, theoretically at 400 for the week ahead. I'm sure that will change, but it's a bit boring when you have options sitting right on the exact price, isn't it? Yeah, 400 being the most loved strike at this stage. And it makes sense. It's a big round number. Bitcoin down around 78% from top to bottom of the rallies. We've talked about 86 and 84% being the key ones. 630, 385, 357 on average around, I think it was like 400 days or something if we take it. And that's because really the drop here was about 420, 430. So we expect crypto to hopefully bottom out by February. Is this the bottom yet? Let's have a look at the charts and discuss it. So we got a new low. That's technically a good sign for recovery, people, because you need that kind of last final swipe generally to take out the stop losses that sit here, to grab liquidity and to push through. I don't like what we're seeing here because we know this is where the supply is. So the market's reacting to that. It hasn't made a new low. So I'm going to set an alert there, 16,300. And if the market makes a new low, you have to think that rallies will be met by sell demand. Key level, certainly important. Bitcoin coiling before its next move. And it's probably not going to do too much, you would think, until the US market actually shows it some sort of direction. At this point, all these markets are connected. If you haven't been looking at economic calendars, now's the time to do so. Make sure that you're aware of consumer confidence, Tuesday, New York, 10 a.m. Then we scroll through. We've got the non-farm payrolls week coming up this week, which will be a lot of fun. We've got Fed Chair Powell coming out to annoy us, 1:30 p.m. New York, Wednesday. Then we keep scrolling through. We've got core PCE price index, manufacturing ISM PMI, and then the non-farm payrolls, the jobs numbers coming out for the US. So it is an action-packed week of economic data. We now know, of course, that data drives the Fed. So we will have to be paying attention to this. And we probably expect some form of fireworks coming into the non-farm payroll. So you'll definitely need to be watching the channel, subscribing, and of course, smashing that like button. So just before we end the video, I want to give a quick shout out again to Tiger Brokers. They've got the 80 free zip stocks for everybody right now that's eligible down below. So just make sure that you consider having a look at that. They've never done it for the US, Singapore, and other people around the world. It's a pretty good little extra offer, and there's nothing wrong with getting freebies. So if you're interested, click on the links in the description, and we'll see you in the next video. Bye for now.